Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing a company that was actually brought up by Tony Myers. I think that's how you say your first name. Pretty much said, can you review TPX? Now, before I even looked into what this company was, I'm like, oh, that looks like a mining company. And then when I looked it up guys, it's actually Tempur bedding manufacturer. That is awesome. That is actually really cool. I haven't done any companies that have to do with like sleeping yet, so I'm actually really excited to analyze this one right now because well, it actually might be a pretty good buy depending on how their fundamentals actually are. So with that said guys, let's get started with this analysis. We are going to come into the dividend summary guys. Believe it or not, Tempur actually does pay out a dividend of 1.57%, which is fairly small. This ends up being 10 cents per share for an annual payout of 39 cents. Payout ratio is around 12.54%, so it is fairly good. However, let's take a look at the payout ratios later when it comes to the free cash flow. What isn't good though guys is this 5-year CAGR as well as the dividend growth in years. They're both at 0. So let's actually see what's going on over that with looking at the dividend history. And we can see here on the max graph that as of 2008, they actually cut their dividend and only brought it back after their stock split after November 23rd, 2020. And they brought it back, guys, fairly good at around 7 cents per share, whereas before it was 2 cents per share. Now, they have been so far fairly consistent with paying out this dividend quarterly, so you can see right here. But it's still fairly new since they decided to reinstate back this dividend, so it might still be a fair assessment to say that it is a little bit risky when it comes to a dividend play, right? Because we don't have enough data to say that they are consistent when it comes to paying out that dividend. Now, ex-dividend date actually passed as of August 10th. Payout date was August 25th, and they pay their dividends quarterly. Coming down to the calculator guys, we got the ticker symbol of TPX, market cap of $4.3 billion with a PE of 8.42 points, meaning that with a current share price of, look at this guys, $24.84, that's actually rather cheap, right? This is telling me that this might actually be a pretty decent buy to buy at today. And looking at this graph guys, we can see that on the year they are down 45.64%, and on the year to date they are down 47.48%. Looking at the 52-week range, we can see that they're more definitely towards the 52-week low than the 52-week high, where they were at $50.51 at the high and $20.03 at the low. So yeah guys, this actually might be fairly interesting to analyze, seeing that we're definitely towards the lower side of what they have been so far this year. Now looking at this dividend of 39 cents per share, in accordance to the shares outstanding guys, this means that they pay out $67.24 million in dividends every single year. So it's actually telling me just off the bat that they don't have that many shares outstanding just by looking at this amount of dividends being paid out every single year. Now, doing the 5-year average free cash flow and then subtracting the 67 million minus that 5-year average, we get that they still are left with $259.36 million in the 5-year average free cash flow. And doing the same math with the last year's free cash flow, they're still left with $531.66 million. These payout ratio guys actually come out to be fairly decent at 11.23% for the last year's free cash flow and only 20.6% for the 5-year average. Essentially telling me that this dividend might be fairly sustainable, even though I just said a couple minutes ago that they haven't been paying out that dividend for too many consecutive years. According to this, they might still be fairly good when it comes to paying out this dividend. Let's take a look at some fundamentals, shall we? Starting, of course, with the net income. We got 5 years ago of $151.4 million to 1 year ago, guys, of $624.5 million. Increase of 312%. Now, looking at this graph, guys, you can see this actually looking fairly good, except for one little part, and that is 4 years ago they actually came down. 5 years ago they were at 151, and then 4 years ago they came down to 100 million. But then after that, guys, they consistently increased it at a good amount actually. So once we get this year's net income, we can actually see that, well, all of that this 5 year ago number will be pushed away. If it's higher than 1 year ago net income, then this would actually be a perfect graph at that point. Now, we have still yet to see that, but nonetheless, in accordance to this, doesn't look too bad. However, I do I can't give it a perfect score because of that 4-year ago value, but I'm going to give it a fairly good score at around like an 80% or so. Coming down to the free cash flow, guys, cash from operations less your capital expenditures, the most important of all the profit metrics, because this is the one that sustains that dividend. This is the one that buys back shares, pay down debts, makes acquisitions, and overall grows the company. Now, I don't know how much growth you could do with sleeping mattresses, but I'm pretty sure there's some formula that somebody still hasn't figured out yet when it comes to sleeping better. I don't know. But nonetheless, guys, free cash flow, very, very important for this thing to, of course, be positive, as well as continuously increasing. And, well, we do see something similar here that we just saw with the net income. But nonetheless, we got 5 years ago of $156.3 million to 1 year ago, guys, of almost $600 million. Increase of 283% with a 5-year average of $326.6 million. Guys, that is a massive, massive increase. Now, I have issues with two things here. For starters, they did go down from 5 to 4 years ago, just like the net income. But what is fairly concerning is this massive jump from 3 years ago to 2 years ago, going from 224.6 million to 543.7 million. Guys, 2 years ago was COVID. Why did they do so much in just 1 year because of COVID? I actually have some, theories when it comes to this. People were staying at home, right? People were probably laying in bed a lot more. People probably bought beds. I think that's the reason what happened there. It's actually fairly interesting because if I would have seen this last year, I would have been like, not sustainable. There's no way. And then to my surprise, well, they beat it. They beat it last year to $598.9 million. Now, the issue is that, and this mainly comes into making assumptions. The issue is that, guys, getting into a lot harder when it comes to an economy. And beds is one of those things that you probably aren't going to get a new bed just for no reason, right? Beds are like cars. When you go into a car dealership, you go to buy a car and you're not going to go back in there unless you actually need another car, or maybe if you just have the money to just throw out in a car. Beds are pretty much similar. You go into a mattress store, you go there maybe once every 5 years or something to then buy a bed, and then you're not going to go back there again. So seeing that times is getting a lot harder. Yeah, I don't think that this is going to be sustainable. Now, don't get me wrong, it is increasing, which is good, but massive jump, as well as here we have a little bit of a dip. Yeah, I would have to go with, guys, essentially like a 60% for an overall grade. Now, looking at the revenue, guys, we got 5 years ago of $2.7 billion to 1 year ago of $4.9 billion, essentially $5 billion, increase of 82.58%. And unlike the other two metrics, we see a very consistent increase overall. Now, from 5 to 4 years ago, it's actually not a decrease. It actually was a little bit of an increase of around $2 million or so. So it's actually a consistent increasing graph. My issue is, once again, this massive increase from 2 years ago to 1 year ago of around $3.7 billion to $5 billion. For that reason, guys, I'm actually going to give this like a 90%. Coming now into the balance sheet numbers, analyzing the assets minus the liabilities. Hopefully this company's assets do cover their liabilities, even though assets is not what companies use to pay down their debts. But nonetheless, we still want to see if their assets are able to cover it, because if they don't, then we have a bigger problem. Now, this is very surprising. As of today, guys, they're at negative $180.9 million. Negative $180.9 million. This means that their liabilities are exceeding their assets by this much. Guys, that's not good. But what's even more surprising is that nowhere within the past 5 years this has happened. In fact, from 5 to 2 years ago, it was actually consistently increasing. And then 2 years ago to 1 year ago, they decreased to $295 million, from where 2 years ago it was $513.5 million, and then it just boom, massive drop. So yeah, their liabilities are significantly going higher, guys, which is not good at all. Average total assets is around $3.4 billion. Average liabilities is $3.2 billion. And doing this difference, we get around $220 million. I do not know what I'm going to put this at, actually, because it was increasing, but out of nowhere, it just went down and into the negative. So I'm going to have to go, guys, with like a 30%. Because I don't know what in the world they're doing when it comes to the 1 year ago and today when it comes to their liabilities. Now, looking at the cash flow minus liabilities, we do the exact same math as we do with the assets minus liabilities, but now with cash flow. the goal of this is to see if their cash flow is getting better and better and the liabilities is getting lower and lower to the point that their cash flow is able to cover their liabilities. Normally what I find with this is that you won't probably find one that's in the positive, but at least are they getting closer and closer to zero. Now, we just saw this massive red one over here in the assets minus liabilities. Now, we do see this massive negative one as of today, guys, when it came to the assets minus liabilities. But looking at the 1 year ago, we can see that their liabilities shot up massively to the point that it actually went deeper in the red. You can see from 5 years ago to 2 years ago, they were actually either keeping it the same or if not getting closer to zero, and then boom, massive drop. So that's not good to see. Average cash flow minus the average liabilities, we get around negative $2.6 billion. Overall, for a grade, guys, I cannot give this a really high grade, right? Remained at roughly the same. Sure, it was increasing to zero, but it wasn't that much. And then out of nowhere, massive drop. I'm going to give this, guys, like a 20%. Now let's actually take a look at, guys, the most underrated of all the metrics. This shares outstanding. The reason why I say that is because people don't tend to look at this. And because people don't tend to look at this, companies tend to issue shares, and companies that issue shares, that is diluting you, the investor. And on top of that, if they pay out a dividend, this makes it harder for them to maintain that dividend because there's more shares out there for them to pay out. So very, very important, guys, for this thing to be decreasing. Now, very, very interesting here. We got 5 years ago of 216.8 million shares to today, guys, of 172.4 million shares. As a decrease on the 5 year of, look at this, 20.5%. And from the previous year to the current year, that is another massive decrease of 187.4 million shares to 172.4 million shares of 8%. That's massive, guys. In both scenarios here, massive, massive decrease. Now, what's fairly surprising is that from 5 years ago to 4 years ago, they actually increased it, going from 216.8 to 218 million shares. But then after that, massive, massive decrease every year after that. So this is actually telling me a lot. Majority of their cash flow after that dividend is paid is going into buying back shares, which is actually a good thing. Meaning that this issue that they're having here with the liabilities may actually not be too much of an issue because they could easily just switch from buying shares to lowering their liabilities, which is actually a pretty good thing to know. Now, for this, guys, I cannot give it 100% because of 5 years ago to 4 years ago, it was a little bit of an increase, but I will give it a 95% just because it is a very good metric. And now lastly, looking at the cash and equivalents, they currently hold $110.3 million with an average of $104.63 million. All right, guys, now let's do a quick overview of all of their fundamentals. Net income, 80%, free cash flow, 60%, revenue, 90%, assets minus liabilities, 30%. That negative one really caught me off guard. Cash flow minus liabilities, 20%, and shares outstanding of 95% for an overall grade, guys, of 68%. It's essentially right there. If they were to fix this cash flow or liabilities, this would easily be an 80% stock for me. So it's actually not too shabby. It really just all depends as to where you think this company might go in the future. But now let's actually see if at the current share price, it is a buy. And now let's come over here, guys, to make some assumptions. Low, median, high, using 3 different factors: revenue growth, the projected share buyback, and the required rate of return, which I like to keep flat at 10%. Now, when it comes to the revenue growth, guys, we're going to come over here to Seeking Alpha and see that the revenue growth forward is actually at 12% and the revenue growth year over year is 17.4%. Now, my job as an investor, guys, is to be fairly conservative when it comes to these values. Now, could I be wrong with my assumptions? 100%. But it is better to be safe than sorry. Now, as I said when we saw the cash flow, I said, guys, people were staying at home during COVID. They probably bought beds. The economy wasn't as bad as it is now. People weren't struggling to buy food and buy gas as they are now. But seeing that the economic wave has actually changed, I think that we definitely do need to take that into account and lowball this a significant amount. So for the low assumption, revenue, I'm going to say at around 3%. For the median, let's say 5%. And for the highest one, let's say 7%. Now for the predicted share buyback, guys, they've been buying back a massive, massive amount of shares, 20%. I don't believe that they'll continue to do this. Hopefully they don't continue to do this because they definitely need to fix those liabilities. So for that reason, guys, I'm actually going to say that within the next 4 years that they're going to lower that projected share buyback down to like 8%, For the medium one, let's say at around 10%, and for the highest one, let's say at around 12%. So roughly cutting it in half for the medium one, right? And now with that, we do get some target share prices, now adjusting for debt of $64.79 for the low assumption, $71 essentially for the median assumption, and $77.54 for the highest assumption. Adjusting for debt now, the way we do this is we take a look at the cash and equivalents, we add the net debt, and if they have more debt than cash, then the value comes down, and if they have more cash and debt, then the value comes up. So you can see it does come down, but guys, by around $20 or so to now $44.53 for the low assumption, $50.23 for the median assumption, and $56.42 for the highest assumption. Now adding also on top of this a margin of safety of 5, 10, and 15%. This puts me between the buy ranges of $37.85 to $42.30 for the low assumption, $42.69 to $47.72 for the median assumption, and essentially $48 to $53.60 for the highest assumption. Guys, the current share price is $24.88. In every single scenario that you look at here, it is a screaming buy, according, of course, to my assumptions, if you choose to believe them or not. Again, this is not financial advice. This is based off of my opinion and my assumptions. That's why I always say in every single video, this is not financial advice, and every investment is the present value of all future cash flow. So please, guys, have these calculators. I have this one, the book value one, and even a reevaluation one. And on top of that, guys, a dividend tracking sheet for everybody to have. Everything is for free. And I even have a link to a video in this description, and that video has links in that description to all these calculators. So please have them, use them, and see what values you would get. Because let's say that you believe I'm wrong. Let's say that you think that, Tempur might actually grow at like what Seeking Alpha was saying at around like 12%, right? Let's say around between these two numbers, 15%. So if we put in here 15% and we keep the same numbers of shares buy back, we can see that, well, now the target share prices is $101, $80, and a range between $67.89 to $75.88. So it really just all depends. You guys can change pretty much all of these numbers here. Yes, even the required rate of return and even the margins of safety. So have these calculators, guys. All I'm asking for in return is just help me grow my channel. Like, subscribe, comment. It really does help it with the algorithm on YouTube. We are so close to 1,000 subscribers. I'm recording all of these videos that you guys have seen so far all in one sitting. So yeah, as if I'm recording this, it is at 973 subscribers. If we could get to 1,000 by the end of September, that would be absolutely amazing. I don't know when I'm going to put this one up, but that would be awesome if we could get to 1,000 by the end of the month. Again, I'm giving you guys free content, free calculators, the occasional live stream, as well as taking your guys' recommendation. All I'm asking for in return, guys, is just 5 seconds of your time. Hit that like, subscribe, comment, and of course just tell your friends if they want to learn how to invest, especially in this kind of market, since we are going deep into the red, guys. Now is a good time to know what companies to buy at a good, decent price. So if you guys have people who want to invest using a fundamental process, please send them over my way. That'd be greatly appreciated. Now let's take a look at this dividend, guys, because this dividend actually doesn't look too bad, right? At least from a sustainability standpoint. If you make the average monthly income of $5,725, if you were to buy 1 month's income of this company, which according to my assumptions is a good buy across all assumptions, this would get you guys 230.11 shares. And at the current annual dividends per share of 39 cents, this gets you an annual dividends of $89.74, quarterly dividends of $22.44, and a monthly dividend of $7.48. So it is on the lower side, guys, but the fundamentals actually aren't that bad. And on top of that, they do seem like their dividend is fairly sustainable right now. So you may want to do it for their growth potential. I don't know. They don't have that many years of dividend growth to see the 5-year CAGR, but nonetheless, from a sustainability standpoint, it does seem good, but it's not too big of a dividend when it comes to buying into this company. All in all, TPX, fairly interesting. I gotta say, fairly interesting. I'm okay with this kind of company, honestly. The fundamentals could be a little bit better, especially when it comes to that liabilities, but you saw by those weights, it was right there, right? It was essentially at 70%. So it really just depends as to where you think this company might go into the future. Remember that we are going into really tough times in the economy here in the US, and that could definitely hit their bottom line, right? Because people are going to prioritize food instead of buying a bed. So to keep that in mind when buying into this company. That pretty much does it for this video. Like the video, like, comment, subscribe. It does help with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.